In 1923, a German professor walked into a restaurant, ordered a cup of coffee and paid 5,000 marks. By the time he finished the second cup, the price had risen to 7,000. How? That was hyperinflation, and it destroyed the savings of an entire middle class in months. But here's what that story leaves out. Some Germans survived that crisis financially, not because they were rich, not because they saw it coming, because they held the right assets. Today we're going to look at the three assets, backed by over a century of real historical data, that have survived every economic crisis in recorded history. And then we're going to ask the question nobody in finance wants to answer honestly. Is your most important asset, the one you carry with you everywhere, actually bulletproof? The data will surprise you. Welcome to Strategic Assets. Asset number one is the oldest strategic asset in human history, gold. And before you roll your eyes, this isn't about being a prepper or conspiracy theorist. This is about looking at 5,000 years of data and asking what worked. Let's start with the 1970s. Nixon ends the dollar's link to gold in 1971. Inflation explodes, stocks collapse, and gold goes from $35 an ounce to over $800 an ounce by 1980. That's a 2,000% gain, while equities fell 48% during the same recession. Fast forward to 2008, the greatest financial crisis since the Great Depression. The S&P 500 falls 55%. Lehman Brothers collapses. $19 trillion in household wealth disappears. And gold? Gold ends the year essentially flat, and then surges 166% over the next 3 years, hitting nearly $1,900 an ounce by 2011. Now here's something important, really important. Data shows that gold is not perfect. In the immediate panic of 2008, gold actually dropped 28% for a few months as investors sold everything liquid to raise cash. The lesson? Gold is not a short-term trade. It is long-term insurance. And insurance only works if you hold it before you need it. The most dramatic modern examples come from countries where currencies collapsed completely. In Turkey, the lira lost 85% of its value between 2018 and 2024. Gold priced in lira, up 800%. In Argentina, the peso has lost more than 95% of its value in recent years. Gold in Argentine pesos, up roughly 3,000%. People who held gold didn't just survive, they preserved their entire net worth, while everyone around them was wiped out. Gold is not an investment. Gold is a monetary escape hatch, and history shows it works every single time, if you're patient enough to hold it. Asset number two is one that the ultra-wealthy have quietly understood for centuries, but that most everyday people completely overlook: productive land, and specifically, farmland. Here's a number that should stop you cold. During the dot-com crash from 2000 to 2003, the S&P 500 posted a cumulative loss of 42%. Over that same period, farmland posted a cumulative gain of 14%. During the 2008 financial crisis, when housing markets collapsed, banks failed, and unemployment hit 10%, the S&P 500 fell 46%. Farmland, it went up 17%. Over the entire decade from 2000 to 2010, which included two major crashes, farmland averaged annual returns of 14%. The S&P 500 averaged a net annual loss over that same decade. Think about that, an entire decade lost for stock investors. The reason is simple but profound. Food is not optional. People stop buying cars during a recession. They stop buying houses. They stop going on vacation. But they do not stop eating. The demand for land that produces food is structurally indestructible. There is one historical exception that you need to know about: the 1980s US farm crisis, when farmers borrowed heavily at high interest rates to buy land. Then commodity prices collapsed and interest rates hit 21%. Land values crashed catastrophically. The lesson is critical. Productive land without debt is a fortress. Productive land with excessive debt is a trap. The asset itself didn't fail. The leverage did. If this level of analysis brings you value, join the strategy by subscribing to the channel. We decode the global markets using visual economics that the mainstream media often ignores. Let's get back to the breakdown. Asset number 3 is the most fundamental of all, and the most overlooked in mainstream financial content. Essential commodities, energy, food, water. The things that human civilization literally cannot function without. Here's the strategic insight. There are two types of demand in economics. Elastic demand, things people want but can live without, like luxury goods, entertainment, travel. And inelastic demand, things people need regardless of price, regardless of their income, regardless of economic conditions. Food is inelastic, energy is inelastic, water is inelastic. What happens to inelastic goods during a crisis? When supply chains break, and they always do during crises, prices spike. Between 2006 and 2008, during the financial shock, average world prices for basic cereals doubled or tripled. After the 2008 recession ended, corn prices nearly doubled in just 3 years as supply chains struggled to recover. In 2022, as Russia invaded Ukraine, two of the world's largest grain exporters, food and energy commodities surged while equity markets collapsed. The pattern is consistent and logical. When the financial system breaks down, the physical world doesn't. People still need to eat. They still need heat. They still need fuel. Exposure to essential commodities, whether through direct ownership, commodity ETFs, or companies that produce essential goods, has historically acted as a ballast when financial assets are sinking. Now, they might be a 4-1, your skills, your human capital, the asset you carry with you everywhere, that nobody can repossess, that no bank can freeze. Is it actually bulletproof? The honest answer from the data is this: hard skills alone are not bulletproof, and the evidence is striking. During the Great Recession, researchers analyzed 83 million job postings and found something counterintuitive. Yes, employers raised their skill and education requirements during the crisis. They became more demanding, not less. But here's the part they don't tell you. As the economy recovered, employers quietly lowered those same requirements again. Skills that seemed indispensable during a tight job market suddenly became negotiable when the economy needed workers. Even more striking, STEM jobs, the ones everyone tells you are the future, actually shrank as a share of US employment between 2000 and 2012. The jobs that grew, non-STEM positions requiring strong analytical thinking and, crucially, interpersonal skills. So, what does the data say actually works? Research from Harvard, Stanford, and the Carnegie Foundation, analyzing career outcomes across decades, found that 85% of long-term job success comes from soft skills and people skills. Only 15% comes from technical hard skills. And a study analyzing 70 million job transitions found that workers with a broad base of foundational skills, critical thinking, communication, adaptability, outperformed specialized technical workers in earnings, advancement, and recession resilience. The conclusion the data forces us to is uncomfortable for the world that tells you to just learn to code or get one more certification. Hard skills get you hired, adaptability keeps you employed, and the ability to think across disciplines, communicate clearly, and solve novel problems, that is the skill that compounds like gold over time. So let's bring it together. The three assets that have survived every economic crisis in history are gold, the 5,000-year monetary escape hatch, productive land, the indestructible demand for the thing all human life depends on, held without excessive debt, and essential commodities, energy, food, water, the assets whose demand is structurally immune to economic downturns. And the fourth asset, the one you carry everywhere, is more nuanced than anyone admits. Hard skills alone are cyclical. They rise and fall with the economy. But adaptability, the capacity to combine skills, communicate across disciplines, and make yourself indispensable to multiple people simultaneously, that is the human capital equivalent of gold. It doesn't depreciate, it compounds, and it cannot be repossessed. The next economic crisis is not a question of if, it is a question of when. And the people who survive it, and even prosper from it, will not be the ones who were lucky. They will be the ones who understood these principles before the crisis arrived. Because that's what strategic assets is about, not reacting to the world, reading it before it moves. This gave you something real, not noise, but signal. Subscribe. We publish a new intelligence briefing every week, and next week we're going to look at the one invisible war happening right now that is quietly draining your purchasing power, and most people have no idea it's even being fought. You're not going to want to miss it.